This would be the number one reason in my mind that the rally's not over in silver. And the number one reason is it's not even a short squeeze yet. Watch the lease rates. The lease rates will go before the price goes. I have a target, and it's derived from math, and it's derived from history, and it's not technical, but it could be technical.
It is Saturday, December 6th, 2025. Welcome back to the Daily Gold YouTube channel. And today we are having our monthly recap video with Vince Lanci. He is an adjunct professor of corporate finance at the University of Connecticut. He's with Echo Bay Futures, and he also writes the very popular GoldFix on Substack. And he finds enough time to grace us with his presence once a month. Vince, so great to have you back. For me, the story of the month, or at least the last several weeks in November, silver breaking above not only 50, but went up to 54, corrected, came back, exploded through 54 a few weeks ago. So you have that move. Gold and the miners, they have not made a new high yet. And also, if we look at the gold silver ratio, that is broken down. So for me, silver is the big story. I know there's a lot that you want to get into with respect to silver, but are we starting to see a short squeeze yet? Is it already happened before the move through 50 and 54? Those are the things that I'm thinking about. What say you in regards to silver?
Well, first of all, the pleasure is all mine to be here. Thank you for having me. Anyway, it's good. Yeah, it's funny, not funny, but interesting, because I've been watching your post on X, and a lot of your chart posts, and I don't do any technical work, but I understand what good technical work looks like. And your posts are the charts, and the subscription I have to your work, I look at your stuff all the time, are giving me tactical reinforcement and confirmation of the things that I'm seeing in the markets. So my view for this conversation is going to be fundamental and big picture, but it's really going to be about the plumbing of what's going on in silver right now, and how I do not believe that we are even in a short squeeze yet. I feel strongly about that. And I feel that way because I tend to have a good grasp on how shorts on a physical market like silver or coffee or natural gas behave when they are under pressure, but don't have any way out. And right now, the silver shorts do not have any way out. It's not to say they won't have a way out, but they don't have any way out right now. What I mean is, when the global silver market is tightening into a slow motion short squeeze as physical supply vanishes, out of China and out of London, demand accelerates from ETFs. There's a chart floating around somewhere that even Bloomberg is paying attention to it now. And financial engineering. The financial engineering part is what's going on at the LBMA level, where futures are being used to roll the problem forward, to delay the inevitable, with the hopes that the metal will eventually come on the market. Someone will pull it out of the ground. Someone will relent and say, fine, I'll loan you the metal for use, or I'll sell my metal. They're trying to use time, and they think time might be on their side. But all these things, the financial engineering primarily, is replacing real metal delivery. So I guess in 3 words, extend and pretend. That's what's going on right now. We are not in a real physical short squeeze. Now, we're going to talk about backwardation, and how backwardation is a sign of physical tightness. It's not a short squeeze yet. Most people have no idea how bad a short squeeze is. A short squeeze is what happened to nickel in the LME. We're nowhere near a short squeeze yet. This market is just breathing a little bit. A little steam is coming off the pot, out of the kettle. But if it doesn't come out fast enough, we're going to have a problem. I did a piece. This is such good timing, because I did a piece after we broke 50, before we ran up to 59. And that piece was a lot of why I don't think we're in a short squeeze yet, despite everyone saying silver squeeze, silver squeeze. And then we ran to $59. So I just put an extended excerpt of that on Zero Hedge. And I think it might be good timing to do that and talk about that now if you want.
Yeah, well, just my very quick question to give you a breather just for a moment is, or not question, my very quick comment. Silver's already broken out of a 45-year long base. It's outperforming gold. The ratio's broken down in favor of silver. And you're telling me we're not even in a short squeeze yet? That's pretty damn scary if you're a bear on silver.
Right, right. Right. We're not even in a short squeeze yet. Now, I want to throw a little water on it to be fair, because we're not predicting it's going to go up. But I'm saying this: we are not in a short squeeze yet. We're in what's called a tight market that is tolerating the rollover. So if the rollovers keep going and keep deferring or extending and pretending, if something gets out of balance, if somebody says, I want the silver, if something else happens, then you will have a short squeeze. If nothing happens and they keep extending and pretending, they're hoping that there'll be supply coming online. Maybe December, maybe January. I don't know. Maybe they get some rich Jew with a lot of silver in a vault to say, okay, I'll load it to you. But I see evidence that that's not happening. Evidence that China is not making their metal available. Evidence from the mainland in China that someone who is heavily involved in the industrial side of silver is now complaining to me privately that, you know what? The buying of silver as an investment item is really screwing up our business. And we're having a hard time here. And I really wish people would stop buying. He's saying it jokingly, but he's not joking.
It's always those damn speculators. They get blamed for everything.
Exactly. I see that. But the funny thing is, I think the speculators are forcing what has to happen. So yeah. So the charts. The thing is, you have been, with the 60-40 breakout in gold, with the breakout of 2009 years ago, and now silver, the GDX breakout, and now silver. And you have a chart that shows silver versus the gold silver ratio. And you said, I want to ask you about that chart. We can either do it now or later, but it's when silver's near highs, this gold silver, not the gold silver, the silver S&P 500 ratio. That's the chart I'm talking about. That something happens there. And I'm going to want to ask you about that. So you have all these charts that are going back to forever, but are showing you signs that you've never seen in a long time. And I'm seeing things that are ridiculously bad for the shorts in silver. And I'm saying we are at a fine balance. And if metal comes on the market, silver drops $9. If somebody says, I want the silver that hasn't said it before, well, then we rally 20 or 30 or 40. It's just not going away. So yeah, that's it. So the charts, I think, are one of the reasons that I'm even more interested than usual. And to be fair, I am long, so I'm talking my position, right? But it's a speculative position, not my physical ownership position. I'm speculatively long. It's funny it's funny because when gold broke above a certain level on my own system, I said, okay, now's the time to buy silver if you're bullish gold. Because I thought, because silver was better, and it broke it out. Like the gold chart looks like it was starting to range again. So I bought silver and gold failed, back to 44,000. I went, oh shit. But I stayed long silver because silver looked better. And it turned out that was lucky and fortuitous. So I am friendly to silver because of investment flows being the tipping point, pushing the physical into a potential problem between now and say January 5th. That's my time frame.
And if there's a problem, what does that mean for the price? Like, obviously it probably goes higher, but does that mean you can see like a vertical move in the price, or it's just going to steadily climb a couple dollars every week?
I think, well, that's the thing, a short squeeze is vertical. A short squeeze is vertical. It's short, it's painful, and people get carried out on stretchers. We haven't had that yet. There are no dead bodies. There's no problem yet. So I think there is a problem. And I think we are in the process of right now doing the first thing that you said. And that is a rolling couple dollars a week problem. Now, it's been my contention forever that the powers that be, whether it be bank heads or government leaders are okay with silver and gold going up in price. Now more than ever, we have to. It's kind of a nod to the BRICS development, but we just don't want it in the headlines. And so when it gets in the headlines, that makes people look at things they don't usually look at. Like, who is short silver? Is it Bank of America? Is it JP Morgan? Whoever it is, I don't know. And so to answer your question in one sentence, it goes vertical if we have a short squeeze. And right now we're in the process of, what would you say technically? Price discovery. The price discovery is either for stops who can't take the financial pain anymore, or what price does it have to go where supply comes into the market? So we're in a relatively orderly, believe it or not, price discovery phase of the market. That's my position.
Okay. Do you want to run through the posts that you
Yeah, I mean,
for Zero Hedge and share some of the graphs that you have?
yeah, I mean, we could do that because it fits right into where we are right now. I think it's, it's something I have behind a paywall, but I want to unlock this for you because I think it's relevant now.
Well, I don't want to make you share stuff that people
Oh,
have to
yes, you
pay
do. You
for.
told
That's
me in
why.
private, you said either share this or I'll never have you on again. No. I think it's relevant. Look, I've already unlocked it. So, and it's really just a lot of pretty pictures. I won't unlock all the words, but we can talk about it. So this is why, okay, so this would be the number one reason in my mind that the rally's not over in silver. And the number one reason is it's not even a short squeeze yet. Okay. The available evidence indicates that large short holders who are called on to deliver metal are doing so when they can. When they cannot, they are deferring delivery by rolling their positions forward. This process extends obligations into future months in the hope that new supply will materialize and ultimately resolve the shortfall. Let me throw a picture up because there's a couple funny ones in here. We should put up. Now, obviously, it sounded like I was reading a script, but I do want to read a little bit of my post out loud because then we can talk about it. Because then we can talk about what happened last week with the expiration where the delivery was not delivered. Let me find. How do I share? I know how to share, but I have to find it again. Oh, there it is. All right. So this is just like my favorite slide. But so here we go. Over the past several months, there has been an emerging tightness in the market, and that tightness in the market is reflected with backwardation. But the backwardation is a sign of a shortage of available supply. It's not a sign that we're in a short squeeze. The short squeeze is when they get squeezed, and they haven't gotten squeezed yet. Now, before we get into what happened last week at expiration, when you are in a short squeeze, or actually when there's a tightness in physical silver, gold as well, but actually it's silver, not gold. When there's a tightness in physical silver, you extend and pretend. Either you find the silver, if you can't find it, you're definitely looking for it, or you incentivize people to give it to you. During that time, one of two things happens. Either they find the metal, meaning people start to bring the metal online, or they don't. And if they don't, the short has to do one of two things. He can either default and not deliver, okay, or he can achieve temporary success by financializing the shortage. In English, he continually rolls forward his shorts and pays a premium every month to not deliver. So you see that backwardation there? Now that we're in backwardation, I'll make a number up. Spot is at 59, right? 1 year out is at 57, let's say. I'm short spot, and in 10 days, I have to deliver. So what do? I buy it at 59, and I roll my obligation to 57. I lock in a $2 loss. I've cost myself $2. I've paid $2 to defer my problem. And that is the backwardation is a direct correlation with what people talk about in lease rates. The lease rates are going up. The lease rates are going up. Lease rates are I have to borrow the metal to give to delivery. And I rob Peter to pay Paul, essentially. And that's where the whole ETF, double dipping on the ETF metal scandal is happening. It's the ETF demand that's caused this. Now, the reason this is, let's see if this slide helps. Yeah, there you go. We were talking about that. So I want to bring China into this, okay? Because this, what happened last week is China based, whether they admit it or not. For the last 10 years, most obviously the last 3 years, last 2 years, China has been buying silver everywhere and buying it from the COMEX, buying it from anyone who will sell it to Africa, buying it from South American silver producers before it gets refined, buying concentrate, buying doré bars. That's standard. People do that, but they've been doing it forever. They've been buying the metal before it hits the exchange. I call it intercepting the metal at the mint, before the mint. Mining intercepted, I think is the phrase I use. Anyway, so that's, China's been doing that. So that's the right side of the map pulling silver. The left side of the map, the US, pulled it this year. And we pulled it in that repatriation thing that happened after Trump got elected and during the tariff pull, the tariff risk pull. And so it seemed like we had stabilized again. But now investors are back. American investors are back. And when you buy SLV, we're going to work without because it's the biggest one. When you buy SLV, the custodian has to buy silver. And they can either allocate silver that they have in the vault. For example, JP Morgan has their own silver. They can say, I'll loan the silver, right? Or they can go in the COMEX and buy the futures, but they must buy the silver. So there are questions about whether they've been buying enough silver to offset their shortage in SLV. And the answer is they have the silver. They just don't have any extra. And so in the past, when someone bought SLV, they would go out and say, I'll just move 1,000 ounces from this side of my vault to that side of the vault. They had that silver to loan, but now they don't have it anymore. They're out. China took delivery of everything. They took everything from, oh, there's the picture that works, right? They took delivery of everything. They're taking it from South America. Now American normies are going, hey, I think silver's kind of cool. I think I'll buy some. That's a nightmare for custodian banks. Now, the reason I'm bringing this up so pointedly is because I did this whole piece before the failure to deliver at expiration. Now, it's not being called a failure to deliver, and I'm not blaming the bullion banks, although I love to do that. On the day, Black Friday, when the COMEX and the rest of the CME, to be fair, shut down ostensibly because they had a coolant failure in a system that's supposed to have multiple redundancies. What happened during that time frame? I have the letter that the CME released, is that during that time frame, several things happened. In the US, a large American custodial SLV bank pulled metal that was available for delivery out of available for delivery and put it in the other category. So they took it from, for those of you who know this, they took it out of registered, which means available for delivery, and they moved it to eligible, which is unavailable for delivery. So it's there, it's available, but you have to move it back. But they pulled it out, my information, which comes from the COMEX, they pulled it out during the shutdown, during the power outage, which is creepy enough. But China, at the same time, silver had made a new high, had a 1,000-lot buy order that ran through the stops when that happened. And so there are rumors that are not unsubstantiated, but not confirmed or denied yet, that there were buy orders that were canceled because they would have destabilized the market. Now, before I mislead people into thinking that I'm going to say something negative about the bullion banks, I'm not. I think the exchange was having a run on it like the LME did. Somebody in China was buying on the Chinese exchange, on the SGE, while the COMEX was shut down, and they wanted to take delivery. I think there's a coordination there. And I believe there was an orchestration to start a real short squeeze. Now the COMEX in its right, I don't know if they did or not. The COMEX in its right, or the CME in its right, has the right to say, no, we don't accept this delivery because we think it's manipulating the settlement process. Not settlement meaning settlement of physical. No, we did that already. I'll just move that just so we can have some movement. So, but what happened was at the same time, JP Morgan and other banks pulled metal out of registered, made it unavailable for delivery. COMEX or CME is rumored to cancel buy orders on the exchange. And China had a big buyer come in on the Shanghai Futures Exchange. The whole thing reeks of trying to orchestrate a short squeeze. And to be fair, the only thing I think stopping bullion banks collectively from saying screw this and letting it blow up is the fact that they actually care somewhat about the exchange's functioning. They're patriotic. The reason I say that is because they don't give a damn about the LBMA. The LBMA is done. They've already pulled out of the LBMA. They're just running it down like it's a old shopping mall that no one goes to, you know? So we're not in a short squeeze yet. And the fact that a bank pulled metal off of the market that was going to be delivered is the bank legitimately or not deferring delivery. And so that backwardation chart means that somebody's going to have to pay another $2 for this trade. So we're not there yet. They're still extending and pretending. That's it. Believe it or not, that's the short version.
Is there any price of silver? Like I have targets of $62 and $66. Like, is there any price that silver moves to or exceeds that it could actually accelerate or even cause or precipitate the short squeeze?
Yeah,
To start beginning.
No, that's actually a question I'm looking at, but I'm not looking at price. What I'm looking at, but the prices I leave to you for technical levels. But here's what's different and what I think we should look at if you have access to it. The market is in backwardation, which means COMEX spot is over COMEX. They can't get it fast enough. But and the price is going up, but the lease rates haven't spiked yet. And there could be two reasons for that. I just want to go into the one that's most common. If the lease rates haven't spiked yet, then there's no problem. That's ultimately what the backwardation says, tightness. The lease rate spike says there's a problem. The lease rate spikes, then you get your prices. 62, 65, 72, 75. Who the hell knows? But you're going to get some serious price action. Then we get that geometric spike. So do I think there's a price point that instigates this? Yeah. But I think that price point will be seen a little bit earlier by looking at the lease rates. So if the lease rates spike again, then you're probably going to see people start to buy the futures, close their shorts, and throw in the towel. So the only places that I have are actually technical. You and I have talked about measured moves before. Well, silver is breaking out of a measured move. And that was 50, I think it was 54 and a half to 43, $9 roughly, 54 to 43. And so if you add $9 to 54, that I have us going to six. I have us, as long as we stay above 57, going to 63 now. But that's technical.
54 and 43, that'd be $11. So that'd be 65.
But no, it's 53 to 44. What's the low of the move? I don't know.
Yeah, you're right. The second time. Yeah, that's 953.
I inverted it. Yeah, I inverted it. No, I inverted it. Yeah. So basically I took the depth and I'll say depth equals distance, which is really the same thing you do when you look at a rounded bottom or a head and shoulders, the depth of the head or the neck to the neckline. It's the same idea. Depth equals distance. And we have a measured move that we're in play, and it should happen quickly. And it's happening quickly, fortunately. So I don't have a level. I'm just telling you, anybody who's got a Bloomberg terminal or who has a way to get the lease rates on a relatively frequent basis, watch the lease rates. The lease rates will go before the price goes. The price hasn't even gone. Remember the rule in physical silver, the price is the last thing to go. Price is what goes up when the lease rates have gone up, when the backwardation is getting too big, and when someone cries uncle. No one is crying uncle. They're rolling, hoping for metal, and they may get it. This is an orderly rally. Like, I don't think people understand this. This is an orderly rally in silver. It's up $2. That's orderly. It's up 7%. That's orderly. Look at copper. Copper had a 3% move in one day. That's massive. It's a much bigger market than silver. That's a big move. Copper, 7.5% move in 2 weeks. I don't hear anybody talking about it. That's right. They don't care about silver as much as we do, at least as much as I do. I know you care about it as well. This is a normal move. And the only reason Bloomberg and all those other media outlets are covering is because it's getting clicks.
They cover what's popular.
Right. Exactly. Well, that's because
why
they're watching you and they're reading me.
Yeah, exactly. That's why Kitco went into Bitcoin and crypto, like whenever it was, 7 years ago.
Don't go there. Don't go there.
But I digress.
No, but it's true. It's true. It's true. Yeah.
Okay. Here's a more of an open-ended question on silver. It's something I've been thinking about lately. So if the squeeze helps cause, let's just say a move to 100 in 4 months or something,
right?
Which is not out of line with the history that I've shown and Michael Oliver has also shown. He's talked about it. So if silver makes that move to 100, there's a squeeze because you mentioned nickel. What happens after the squeeze? Like, what is the floor? How much could silver come down when the squeeze runs its course? Or silver has some built-in support because it's half gold, it's half industrial, it's half monetary.
Yeah. For me, the answer to that question lies in how do I think the exchanges and governments react? And that's a really important question that you're asking. People frequently will talk about a market. If it goes up fast, it'll come down fast. And then other people will say, if it goes up fast, it'll stay. If it goes up, it'll stay up. So slow and steady wins the race. If we have a hyperbolic move, not hyperbolic, if we have a geometric move because of a short squeeze, it will be short-lived. I don't want that because I won't be able to sell in time. So I'll give you an example. I have a target and it's derived from math and it's derived from history and it's not technical, but it could be technical. And that is, here's my logic. Actually, because I'm thinking about what you're talking about right now. And the nickel example is very instrumental. First of all, my target is $143. Why is that my target? Because when critical minerals, when lithium and uranium were listed as critical minerals, that's the average move that they had within 5 years. So I had this target when silver was at $40, $35 actually. And I wrote about it. And it was like when we listed it as critical, when we officially listed it as critical, I said, well, let's see what lithium and uranium did because technicals won't help me. I'm not going to do Fibonacci up there. I mean, you can, don't get me wrong, but without a level above $50, what would I use? Fibonacci extensions, Gann lines, stuff like that. And that's not enough for me. I needed an anchor. And the anchor is lithium and uranium, when they were made critical, within 5 years, they did X. And so the answer for me was within 5 years, silver triples, more than triples. Okay. That's the conservative one. I'm not going to say what the other one is. The other one's like, another like 8 times higher, but because I don't think I'm going to be able to sell it. So my answer is within 5 years, silver will trade $143. I'm 99% sure. If it gets there tomorrow, I will sell everything. Why? Because, and this might be hard for people, not everything. I will sell my speculative position. It's invisible. This might be hard for some people to understand, but if you have a target for something over 5 years and you think it's going to go up, say 300% in 5 years, that's 60% a year. If you can make 300% in 1 year, wouldn't you take the profits because that's what you were budgeting for and move into something else? And that's the idea. Because I think long before it gets to $144, your question gets answered. At some point in a vertical move, someone steps in, the government steps in. Nickel, they canceled trades. They canceled buy orders after the fact. The LME got sued for that. I'm sorry, the LME? Yeah, the LME. The LME got sued for that. In fact, they're out of business basically because of it. And the exchange has, and I want to say this to be completely clear, an exchange has and I say this as a patriot, a U.S. exchange has every right to step in and stop things for critical minerals. If silver wasn't a critical mineral and they stopped it, that's bullshit. But once you list it as a critical mineral, you empower the exchange to do what needs to be done to protect it. What could they do? Well, they could cancel delivery on the COMEX, and they will do that. They'll do it before SLB cancels. That's my opinion. People are like, oh, SLB shit. COMEX is, but no. COMEX is a global futures exchange. SLB is a domestic spot market. We're not going to let people take our silver. I'm sorry.
Just do a 10-second interruption here. They stepped in 1980. The Hunt brothers. I mean, exactly what you're talking about.
Exactly. Like, I don't think people like, it might not be someone. Here's what happened in 1980. I've been told this by one of the older guys. I'm the older guy now, right? In 1980, when the Hunt brothers were doing what they were doing, the heads of the exchange, which was basically the executives of the exchange and the miners, the producers who had all the seats, went to the CFTC. I was told this, and I've heard this in more than one place. Chris Marcus verifies it as well. And these executives and heads went to the CFTC and said, you've got to stop them from buying silver. What they're doing is illegal. Silver's not a critical mineral. CFTC said, we find no wrongdoing here. You have to handle this. CFTC doesn't want to get involved unless they really have to. So I think this is before they had, the exchange got together, the board members, and they said, let's make it liquidation only. And you would have thought that everyone had to liquidate. But if you're short and you know it's liquidation only, and you know it before the longs do, and you know that the Hunt brothers were using profits in silver to buy more silver, they were just extremely leveraged. Well, all you need to do is lead the market after making that announcement. And the Hunt brothers fall out of bed, and the miners are safe. The producers are safe. And, by the way, I mean, it's obviously a horrible thing for free markets as a libertarian, but as a person who's worried about the country, I would say, you know what? You should have known they were going to do something like that, because they're not going to let the exchange go under. The exchange exists for the producers, not for the speculators. People forget that. So now fast forward to today, same situation, but this time it's a critical mineral. Orders will get canceled. Trades will be stopped. The market will be stopped. There will be all kinds of things that happen. You're seeing it happen right now. I mean, with the registered to eligible change, with the cancel of the nickel orders. I'm saying this as a greedy, long-term person. I do not want silver to have a short squeeze. I want it to be a slow, rolling, painful cancer on the shorts. Sorry to be so pointed about it, but that's what I want. I want them to pay me $2 a month. Pretend that I'm short, I'm long spot, I'm long the front month future, and they're short it. I want every month for them to say to me, Vince, do you want to take delivery? And I say hypothetically, yes. And then they say, well, we don't want to make delivery. We'll give you $1 to not take delivery. And I'll say, fine, I'll take $1. The backwardation becomes a dividend. The banks and the producers make money being short the contango. They're long spot, which is over in London, and they're short the COMEX future, which is above it. That's what they were doing. It's cost of carry. They have the low cost. They have the low cost of production. They have the low storage costs. They borrow at the lowest rate. So the contango is, let's say, 5%. They're like, well, we only borrow at 2%. Sell it. And they made that money. It was a dividend for them. It was a tremendous rate of return. The metals are like the best carry, almost as good as the Japanese carry trade has been. And the Japanese carry trade is unwinding. And now, in metals, that carry trade is reversed. they're getting taxed every month. So I want it to continue to roll in a slow, orderly fashion. I do not want to wait the CME bear. Let it be an orderly market and we can be fine. That's what I want. I don't want it to go to $144 tomorrow. But if it does, I will sell my specs. The order's there every day. I put an order in every day, which it'll never get there until it gets there. So that's it.
No, I completely agree. From a minors and juniors standpoint, you have a
Yeah.
huge spike like that. The market is not going to discount these companies being valued at $100 or $140 silver if that happens in a day.
Right.
What's the best thing for minors and juniors? The real price of silver just keeps rising. Just give me gains in the real price of
Yeah.
silver every quarter, every year. That's the best thing for these companies. If inflation is 2% and silver, goes to 60, or if inflation is 8%, silver goes to 70 in the next year. That's all they need. That's really good for them. You can make
You
a
know,
lot of money in these companies.
I,
It just goes way up like that, and it goes back down and reverses 70% of the whole thing. That's not a net gain
right,
for your
right.
stocks.
I'd like to add something to that.
Yeah,
I
please.
started in the industry as a fundamental analyst on the equity side. It wasn't minors, fundamentals. And volatility rewards speculators. Volatility punishes investors. And aside from the fact that what you just said, I want to add something to that to make it even more obvious to people who aren't getting your message if they're not. The message is this: I buy futures for leverage. I put $2,000 in, I control $10,000. That's leverage. But when you buy stocks, you don't use financial leverage if you're smart. Why? Because the company uses leverage. They have financial leverage if they're borrowing. I don't like that in silver, but they have operating leverage. So the price goes up, they can produce more. They can throw another bulldozer on it or whatever they do. They can increase their output. Operating leverage is what makes investors take risk further down the road. So the whole key to understanding investing at a versus commodity trading is a very simple equation: the price to earnings ratio. The price to earnings ratio is outdated, no one cares about it, but at its base, a price to earnings ratio tells you how volatile a company can be. Here's what I mean: the PE for a stock really is how much time does it, how many years does it take for that stock, that company to earn the money you've invested in. So if I buy a company that's trading $50 a share at a 20 PE, it takes 20 years for them to earn the $50 back. That's the key. So you can't extrapolate PEs if the commodities price is too volatile. You want slow and steady. Slow and steady kills commodity volatility, but it explodes valuations in miners. You don't want a spike and dive because John and Nancy Q Public are like, oh, that's too volatile. I don't want to be involved in that. And who wants to be involved in Bitcoin? It's the same idea. These people are scared. This is 401k money. The whole United States is going to put their money into miners, and they haven't yet. Miners and energy stocks, because they're all relearning the lessons of the 70s. And the banks are pushing them into it after they get possession. So I think you want slow and steady wins the race. Keep it out of the headlines. Keep the government happy. Let the banks lose money. I don't care. The government will subsidize them, give it too big to fail thing. I don't care. Just let it stay under the radar and just keep going up. Because frankly, if silver were to spike to $140, I would sell everything, wait for it to go back to $50 and just buy miners. Because no one's going to want miners again because of the scariness of it. But they're going to keep making money and I'll just get dividends 20 years from now. So that's my game plan, so to speak.
All right, very good. Should we talk about gold and what's going on?
I don't want to.
Have
No, I don't want to. I want you to pull up that silver chart and explain something to me. You have a chart, it's silver on the bottom, and on the top, it's silver versus stocks.
Sure, yeah, I am pulling that up.
Oh, you got it?
Okay,
All right,
there we
please
go.
explain this chart to me and everyone, obviously.
Okay, so the bottom is silver, just nominal silver. This is the scale for nominal silver. You know, I meant to delete a few of these things because I don't want to confuse people. But so again, this is silver here, left scale. The right-hand scale is silver divided by the S&P, but it's inverted. So we're actually looking at S&P 500 divided by silver, but it's an inverted scale. You know,
Oh,
when
it's inverted.
it's inverted. So when it's moving up, it favors silver. But this is how best to view it. Excuse me, because otherwise the numbers, you know, they're like fractions.
Yeah. Right, exactly. You'd end up moving the decimals anyway if you said S&P divided by silver. Right.
And so, yeah, this is historical data from somewhere because I know the S&P didn't start until 1940 or 1950. So this is historic. I can't recall where I got it from.
Right.
But anyway, this goes back 170 years. But, you know, this was a major inflationary peak. Civil War, 1920 was the next major
Right.
inflationary peak, 1980 here. So I've talked about this before. So I'm not a big cycles guy, but super long-term cycles, every 60 years, there tends to be a major inflationary peak. And so to me, it's so interesting how we're basically early 70s or, you know, mid 1960s territory, because if you look at, you know, the mid 1960s or the early 1970s, and you could see this move here after 1965, that
Right.
precipitated an actual mania in junior stocks. So the market took out the 1920 high, and so that was a fairly expensive price at the time. Even the same thing in the you know 1973 when it finally broke above the Civil War peak.
Right.
Look at where silver against the S&P was. You know, it was still way below. I mean, it was like around 100 or 70 or 80 at this point in time when
Right.
silver had already basically made a new all-time high. It's the same thing here where, okay, this is monthly data, by the way. So we know that silver has broken out. It's at a new all-time high. And look at where this is. It's not even at 100 yet. I think it's like at 117. So,
Okay. Hold on. All right. Let me see if I understand what you're saying. When silver makes a new high, like it did in 1960, looks like 1967, that first one,
yeah.
and then it sold off, and then it makes a more substantial new high in 1975, you're at the beat. You want to look at the S&P versus silver, and you want to say, hey, where is that? And that still has a ways to run. Okay. So it's almost like silver rallies and then stocks sell off.
Oh, yeah.
You follow me?
Yeah.
Like,
Good.
here's
Yeah.
what I'm,
Good
here's what I'm
point.
getting
Yeah.
at about this, but this is good. So, but you're saying silver leads the silver S&P relationship. And I'm saying, from my point of view, yeah, that tells me two things. In general, commodities go up when stocks go down. And two, and I love saying this part, silver's not fucking economic. Because if silver was economic, it would go down when stocks go down. So it's bullshit. Silver is precious. When the shit hits the fan in stocks, silver becomes precious. That's it. I love this chart. Right. So
Yeah.
you're saying here's silver at the all-time highs again, making new all-time highs, and the silver versus S&P ratio is just getting started. And I'm saying short stocks, buy silver if you really want to be crazy about it.
Yeah. I just hold it for 10 years.
Yeah. So you know what that says to me? Actually, as a trade, I did this trade and it worked, but I didn't hold on to it very long. That says buy miners, sell the broader market. That's what it says. In fact, have you done that? Have you looked at the S&P versus, I know you've done the S&P versus GDX over the same time frames?
Well, I mean, I could, yes, I've looked at the Barron's Gold Mining Index. I do have that
Right. I know
against
you
the
have. That's why I
S&P,
asked.
but I haven't actually looked at that ratio recently.
Well, I mean, it makes
But
sense, right?
yeah, but it's fairly similar to this actually, but it's actually stronger because gold stocks have been stronger than silver until very recently.
Which makes sense. Silver doesn't catch up until it catches up. And of course, when silver goes to $150 in 3 minutes, that'll be the end of the bull market and everything. They'll make owning gold and silver illegal, and they'll confiscate our guns. And then we'll be left, using aluminum, and copper. Right?
Yeah, and eating cat food and dog food.
Exactly. 1977. Cat food and dog food. I knew a guy who ate it. All right. Yeah, you want to touch on gold? Pull a chart up on gold. I mean, gold's boring. Gold's a pet rock.
Yeah, most of the charts I've been looking at. Yeah, I actually don't have anything that's. I mean, okay, big picture. I guess we could look at this one.
So while you're
Screen.
pulling it up, I just want to say, so what I'm noticing is from the analysis and fundamental point of view, I'm seeing calls for 5,000 gold and no calls for higher silver from the bullion banks, except for UBS. So I'm wondering
That they don't want to cause. They don't want to cause the squeeze.
yeah, exactly, exactly. You know, that's a good point. And I did see something on Friday. In fact, anyone who's listening to this, if you go back to Friday, you'll see gold takes a dive and silver takes a dive with it, and then gold does not rebound and silver does. That tells you two things. One, that the banks, as I've said for years with you, the banks trade one against the other. They have been short silver forever and buying gold when the central banks were buying. And so they're doing a carry trade, short silver, long gold, short silver, long copper. And now they can't do it anymore. There's no silver available. So now instead of selling silver to buy gold, they're selling gold to buy silver. And it's not so easy because the silver market, if you sell silver, gold buyers will go like this. Gold buyers will say, they're not going to sell. They'll just back off their bid and let it come to them. Oh, I'll be more patient. But when you sell gold, you can't sell gold down with one contract. You got to sell 1,000 contracts. And that's not easy to do. So these guys are rolling their problem back into gold. So the next leg higher for gold comes when they have to cover their gold positions. It's crazy, but that's the way it is. Like if I were running, I want to mention one final thing. I'm talking to the bullion banks here. If I were a bullion bank, I would be selling the shit out of gold and buying silver. Why? Because at least you can get the gold leased to you from the BIS or from another central bank in the West. There's no silver available to be leased. And all that heap leaching metal, it's gone. China is eating it up. And the US is now saying, we're going to eat it up too. It's over. It's over. The game is over. The Japanese government bond carry trade is over and the silver carry trade is over. Anyway, unless it's not, I could be wrong. We know. I'm sorry. So what am I looking at here?
So this is a big picture chart of gold. We're looking at the two biggest breakouts in gold's history compared to the current breakout, which began 18 months ago. So the two biggest breakouts, or I should say the three biggest breakouts in gold's history. Number one, 1972. That's the one in blue. The other line is 2005. That is the third biggest breakout. And then number two is the current one. So I'm looking at number one and number three. Well, actually, that other line there, which has the two, I'm sorry, the colors, the one in the middle that we can see so far, that is an average of 70, the 2005 breakout and the 72 breakout.
Wait.
So
hold on, do this for me. I know the color things that pain in the ass. Plus I'm wearing these glasses. Which line are we looking at? Is it labeled with a price? What's the price, or is it not labeled with a price?
The black one, that's the current market.
So you want to look at the current market that hasn't finished its move. Okay.
Yeah. So that's weekly data. That's so this began right before the breakout move in March of 2024. So I began it at the end of February. And so we're comparing that to the same similar moves that occurred or that began with the 1972 breakout and then the 2005 breakout.
Oh, I see. So the 1972 and 1975 breakouts are the same starting point. And what you're basically saying is if we follow one of these, we go to 6,900. If we follow the other, we go to 9,200. Is that what you're saying?
Yeah. Yes. The 6,900, that's an average of the other two.
Right.
So that's an average of the number one and number three biggest breakouts in gold.
Oh, I see.
The current one is number two.
Right. You don't 1972 and 2005. Oh, I see. You know what? It's my glasses. I have the blue blockers on.
Oh, yeah.
When I put the blue blockers on, the purple line, that's the actual color, lavender purple, turns red. Okay, so basically, the lavender line, the line that's labeled 6,900 on the right, that's an average of 72 in 2005.
Those breakouts.
Right. So that's an average, right? So you don't have the 2005 breakout there, but you have the 72 breakout, which gives you the peak And that would imply that the 2005 breakout is under 6,900. And so it looks like right now, we're on either one of those two paths. Great.
Yeah. Yeah. I don't think that this will be as strong as the 1972 one. No, nor should it be, because that was the greatest breakout of all time in the history of capital markets.
Right.
But as I've said, there's a lot of similarities to that.
Yeah.
But we're probably, we're following that, but with some kind of a lag. I don't know if that's the right word, or maybe we're following 85% or 90% of the
Right.
strength of that move. And we're above the '05 move by itself. So that's why I'm looking at an average there.
I see. Right. The '05 move isn't in play yet. Right. Right. It's a moving
For
average for us.
Yeah. And I mean that look, we're almost that's like set potential target of like 7,000 gold within 18 months.
Yeah.
So
And I did a post on Jeffrey's analysis, which said, and this is an interesting metric. I don't have the numbers in front of me anymore, but they came up with like 6,400 and change. And their number is based on, and this is kind of cool. I mean, this is something I think you might look into. Their metric is based on, what percentage of household assets were in gold. So per capita.
no,
And
that's
so,
what was it? I'm eager to hear.
I don't have it. I have to find, I'll send you the link, but I did a whole breakdown of it. And basically they said at the peak, this is what they said, at the peak gold price of $800, the percentage of American capital net worth was blank in gold. So the peak of that now would be 6,500, some weird number, $6,550. So they did that analysis, and then we did another one, and the other analysis was, what would the price of gold be if we did that tied with M2? See, Jeffries had a nice chart. It was gold's price, M2, and gold as a percentage of per capita ownership in the United States. I forget the actual metric, but all three of them coincided as a peak. And then they said, we're only going to look at the per capita number and extrapolate it out and said gold should peak at that percentage of U.S. families' net worth. And that would be 6,600 or something like that, 6,500. And then the other line is the M2. And the M2 number, which again doesn't come into play, and they didn't talk about it, but the M2 number is 12,000. So the M2 number, so you have the M2, you have the per capita, you have gold, $800, bing. And then you have going forward, you have the M2 at 12,000, you have the per capita number at 6,500. I tend to think the 6,500 is legit because that's the sign of panic. When everyone in your family has 20% of their money in gold, that's the panic, or 50% or whatever.
Yeah, but if everybody had 20% of their money in gold, you could put another zero on the price. Like they're
Right.
they're
I
really
understand. I'm making a
they're
number up,
really
like,
I
whatever,
know.
whatever the number was, like, 12% of their net worth or something like that.
But my point about this chart is we're in a major breakout. This is what major breakouts in gold do. Like this
Right.
is what it should do. And there's
Right.
nothing, I like to use current prices and current margins for evaluating minors and juniors, but I mean, this is what should happen, honestly. Maybe it takes a little longer, maybe it takes another year. To get to that point, we're probably going to see a 20% correction at some point.
Yeah. Yeah.
As you can see happen with 72. I mean, you had minus 26 here, minus 23. I mean, the '05 had a minus 23% decline in
Right.
2006.
Right.
So we're not going to continue to have this. It's been really tame and fabulous. But
Right.
this is what should happen based on major breakouts, based on how it's been acting for 18, 19, 20 months.
So I'm looking at this and I'm looking at, those pullbacks and those other two analogs. And I say, we haven't gotten the pullback, but I still don't want to discount that we're not going to get it. My point being is you just said it might take longer. And if it takes longer, maybe the pullback comes next. And then the next mountain comes, 2 years off the chart. You follow me?
Yes.
I'm just saying, I just want to be aware of that. Yeah. The difference between the 1972 breakout and now is obviously we came up the gold standard Everybody wanted gold. You couldn't own gold. You're going, oh, in the futures, fine. I get that. And we're not going through that now. But there is a kicker to this move that hasn't showed up yet, and I believe it will show up. Blockchain gold, tokenized gold is going to be a product in the US. It's going to be a product in the Middle East. It's going to be a product everywhere. So whether you say it's real gold or not, I don't care. It's going to drive the price up because the normies don't want to have a vault in their house with gold in it. They're going to say it's the closest thing to it, and they're going to buy it. And it's going to be a race between, can we get the gold? Can we keep a lid on it? Versus the retail onslaught of the decentralization from this. So we could have a nice kicker near the end. But when the end is, I have no idea.
Yeah, there's one more thing I want to get your opinion on because this is a very serious. Okay, Vince, this is something I've been wanting to ask you about over the last week or so, and it dovetails with what you're mentioning about Jeffries. And that is when you look at this information
Right?
in these charts and how there's a structural under ownership of gold,
Right.
despite this is even after the last 18 months.
Right.
You know, we've had incredible, this is a historic, like the second best, probably the second best 18 months ever in the
Right.
history for gold, going back to 72 to 73. And how do you, I guess, as a trader and investor, like, how do you factor in this information? Because what I am seeing is, you look at your charts and then you find support, the moving averages, you look at some history, but gold has undershot all my correction expectations over the last 18 months. And I think it's because of this information here, where there's a structural under allocation in the market.
Right.
And, some people think that this like cyclical, like we could get a real blow off in the next 2 years, like it could end, this cyclical bull could end
Right.
sooner than people think, like it may be in the next 18 or 24 months. But when you look at this information right here, the structural under allocation of retail and also professionals, I mean, that just doesn't this mean we could do like an absolute moonshot in the next couple years? I mean, maybe if people think it's going to last 2 years, it'll last 3. But I mean, how do you make sense of the great performance we've had, yet the fact that not that many people have come on board yet?
Okay. All right. Yeah. 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 There's a couple points to make based on that. That's all very important. First of all, the public buying hasn't started yet. These are my assumptions. It's just starting now. Second of all, meaning central banks are still buying and the public is just getting started. Second of all, and I think should not be underestimated, should not be ignored, is that for the last 50 years, we have been in a neo-Keynesian environment. And a neo-Keynesian environment generationally has told people that gold's not something to own stocks. And it's worked. And so we have printed more money ever. And we're printing more money to print higher stock prices. And so we have been successfully brainwashed as a culture to not buy anything physical. We have cultural, like all encompassing. And that has killed miners. And over the last 50 years, there were competing assets for inflation. You don't want to buy gold, buy tips. You don't want to buy miners, buy energy, right? You don't want to buy these things. You want to buy these things. And all of our money in our market structure has been in the stock market. And so you can take your money from your savings account, hit a button and buy stocks. You can't take your money and buy gold. The market structure for 50 years has been steering money away from precious metals, has been steering money away from anything that undermines the dollar's dominance globally. So I'm saying first of all, we cannot underestimate the effect that has had on the psyche. Now, with those two things in mind that I'm saying, central banks aren't done buying. They have another probably 25% more they need to buy and then some. When you take that, but more importantly, what I just said about the neo-Keynesian era, the fiat era is another way to look at it. And then you add in the technology that is going to decentralize ownership and allow us, I'm talking about the people in power. The people in power can say, we can let the gold and silver people have gold and silver without worrying about the physical. We'll use blockchain. And of course, they'll screw that over like they screw everything else over, but not for years. So now you have the money is printed. It's already printed. It's all out there. It's all in one stock, NVIDIA. No money is in gold. You have a choice as a person in charge. You can either stop printing the money and have the stock go to zero and have 401ks go to zero, or you can give them another vehicle to put the money in, which is a liquidity sponge. You could orchestrate another bubble. The technology is out. I have a bank that allows me to tokenize gold, and people want gold again. They're going to push that shit because it keeps the money domestically in a security, even though they're buying gold. What am I saying with all this? What I'm saying is, unless central banks turn seller over the next 12 months, the government can either stop printing money and have NVIDIA drop and have nothing else go up, or they can stop, or they can keep printing money and slowly have money come out of NVIDIA and go into gold stocks and gold. I believe that we're under-owned. To answer your question, your main point, we're under-owned because of 50 years of brainwashing. And we're now, we meaning gold and gold miners, are now an alternative asset that the government is going from hating because it competes with the dollar to embracing because it allows us to keep printing money. Look, if I'm the government and people want to own gold, that's bad for the dollar, right? Because I've been telling everyone that gold in the dollar, no, but don't do that anywhere. Say, let them buy gold. As long as the gold stays in the country, I don't give a shit. And it's all working towards this being a 2 years from now saying to you, we're in a gold bubble. And it won't be a 6-week bubble or a 6-day bubble. It'll be a 6-year bubble, just like NVIDIA's been. The mechanics are the same. Create a stock, get people to buy it, it goes up. And while they're coming off, find another stock. Oh, the Mag 7's coming off. Let's do data centers. Oh, the data centers are coming off. But I guess it's gold's turn. It's going to happen. That's what I think is going to happen. And so I think we're going to have a bubble. And the reason we're going to have a bubble, we're not anywhere near it, is because the BRICS are really buying it. Because the BRICS really want the gold. And so if they're de-dollarizing with gold, and we want to make sure that our people are protected, because to an extent we do to an extent, then we're going to have to allow them to participate in gold. We'll financialize it. Look, be a Bitcoin conspiracy theorist. Bitcoin is a government-run product, or it's not, but the government sees it as a liquidity sponge. It's convenient. Well, we can either stop printing or we can tell people to buy Bitcoin. What's Trump doing? Buy Bitcoin, buy Bitcoin. And it's not working. They're going, well, it has worked. Let's be clear. Now they're like, yeah, you know what? I think I want to buy gold. Meanwhile, Bitcoin has flatlined in volatility and gold's got more volatile. Like, geez, this is crazy. The government is just looking for another another cup to hide the P up there. And so at some point, gold becomes the bubble of choice. That's what I think. So that's why we're under-owned, and we're going to be, we're nowhere near being over-owned. And unless the central banks turn seller, that bid is going to be there forever. To your point, the floor is being raised. At first, it was raised by central banks in the BRICS. Next, it'll be raised by U.S. investors. And then next, it'll be raised by Western central banks. And then you'll have your bubble. We're nowhere near that yet. We're under-owned.
It's a great way to end it. And thanks for answering my super long-winded question, by the way.
And thanks for listening to my super long-winded answer, right?
As always. Now, Vince, before I let you go, please tell our listeners how they can subscribe to GoldFix.
Sure. GoldFix is a newsletter that comes out sometimes 3 a day, at least 2 a day. And it's the focus is on money, precious metals, to a lesser extent miners, and geopolitical tensions and all the drivers behind the gold price. And it's VBL GoldFix. VBL, Victor Boy Larry, GoldFix on Substack. Or you can find me on Twitter under VBL's Ghost. That's it. Love to have you.
Thanks, Vince. And I'll just say to all the listeners and viewers out there, look, if you want to be informed on everything that's happening in gold and silver markets every day, and you want to know who's buying, who's selling, who's going to come in and buy later, and all those things, all the relevant news. Nobody does it better than Vince. So get on over to GoldFix and subscribe, everybody. And Vince, thank you so much for coming on, as always. Happy end of the year. And, next time we do this, it'll be 2026.
Right. Thank you for having me, and I'll see you next month.
Thank you for tuning into the Daily Gold podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.